Salam everybody, this is Investor Shake back at it again with another video. And today's video is about how to trade options the halal way. Now let me open up Robinhood. Now there are two types of options. There's a call option and a put option. Now, an option in general is a contract that gives you a right to buy or sell 100 shares of a stock at a certain price by a certain date. So, a call option gives you the right to buy 100 shares, and a put option gives you the right to sell 100 shares. So on Robinhood, they display this in a very user-friendly format. As you can see, there are various expiration dates. Now I have Johnson & Johnson stock as an example. That was one of our halal stock picks. So if you want to check that out. So all these expiration dates are on a Friday of each week. So the price of a contract is called the premium. When you buy a call option, you pay that premium. So in Robinhood, they give you a pretty concise definition of what it is. So basically, if you think the stock is going to go up, if you're bullish on a stock, you would buy a call. And it says here, it gives you the right to buy 100 shares of the stock at the strike price by the expiration date. You could profit if the stock goes up, and you could lose money if the stock goes down. And then for a put, it gives you the right to sell 100 shares of the stock at the strike price by the expiration date. You could profit if the stock goes down, if you're bearish on the stock, and lose money if the stock goes up. Now, essentially, when you're buying a call or a put, you are betting that the stock price is going to go up or down. However, the concern is that is similar to gambling because it is a pretty risky bet. It's a lot more riskier than owning the shares. So I'm not really going to condone buying call options or put options. Now, when it comes to trading options the halal way, the way you could do it is by selling calls and selling puts. That is the opposite. So the definition is to sell a covered call or a covered put. So when you're selling a call, it gives you the obligation to sell 100 shares of the stock at the strike price by the expiration date. You'll earn a premium up front, but might be obligated to sell the shares for an unfavorable price. So basically, to sell a covered call, you need to own 100 shares of the stock. So for example, if you have 100 shares of Johnson & Johnson, and you think the stock price is not going to go up by February 5th, what you can do is for example, if you own 100 shares of Johnson & Johnson, which is currently at 165, you can sell a covered call at various prices. So for example, for February 5th, you want to, let's say you want to buy or sell a covered call at the 175 strike price. If you sell the covered call, you will earn a premium of $35. Now it says 35 cents here because that's the price per share, but when you do options, it's in multiples of 100. Each contract is 100 shares. So you're getting paid 35 cents per share for a total of $35. So if you own 100 shares of Johnson & Johnson and you think the stock price will not pass 175, which is the strike price, the option will expire worthless by Friday and you get to keep the $35. However, if the stock price of Johnson & Johnson passes 175, let's say it goes up to 180 because of some catalyst that caused the stock price to go up, you will be forced to sell all of your shares for $175. So it's a way for you to earn passive income using the stocks that you already own, but you have to own 100 shares. Now I'm using Johnson & Johnson as an example, but you can do any stock. Now the opposite is for selling a covered puts or a cash covered put. Instead of owning the 100 shares, you would have cash set aside that's equivalent to purchasing 100 shares. So the definition is, by selling a covered put, it gives you the obligation to buy 100 shares of the stock at the stock price by the expiration date. You'll earn a premium upfront, but might be obligated to buy the shares for an unfavorable price. Now you can only do this if you want to buy 100 shares of the stock at a price that you want using the cash. So and then you get paid a premium, just like if you were to sell a covered call. Now for example, February 5th. So for the cash covered put, you need to have enough cash that's equivalent to 100 shares. So essentially, if you want to own 100 shares of a stock at a discount, a cash covered put would be the way to go. So let's say you have $16,000 cash and you want to make money off of that $16,000. What you can do is you can sell a cash covered put at the 160 strike price by February 5th. So if you have $16,000, you can sell a put and you will get paid a premium of $144. You get to keep that $144. However, if the stock price goes below 160 by February 5th, that $16,000 you put aside will be used to buy 100 shares of Johnson & Johnson stock. Now this may be a good strategy if you have extra cash that you want to use to make some extra money, or if you want to buy 100 shares of a stock at a lower price. So if it's at 165 right now, you want to buy it for $5 cheaper. That's what selling a cash covered put would be the option. So the premium is a nice way to earn some money. It's kind of like earning a dividend. So you could essentially do this every week to earn passive income, and you can use that premium to buy shares of whatever stock you want, essentially. Now, that is a lot less riskier than buying call options and put options, which is a lot riskier because if you were to hold on to the options by the expiration date, it could go to zero, which means your money's gone. But selling options, I believe, is a lot less riskier, and frankly a halal way of using your cash for puts or the shares you already own for calls. This is Investor Shake checking out. Follow my Instagram @InvestorShake.